We begin with what many Canadians have long been waiting for, the country's first interest rate cut in 4 years. In 2022, the Bank of Canada began aggressively hiking rates. The cost of living was spinning out of control, and inflation needed to be reined in. 10 rate hikes later, an 11-month pause, it's now begun to come back down. Today, just a quarter percentage point. And this is why. Inflation in Canada is getting closer to the bank's 2% target after peaking at a 40-year high in 2022. Peter Armstrong is the CBC senior business reporter. He spoke today to the Bank of Canada Governor Tiff Macklem, and he joins us now. Hey, Peter.
Hi, JP.
So, Peter, first, what are some of the key takeaways from today?
Yeah, without getting too deep into the first cut of the deepest references, this is a really kind of interesting moment of the last 4 years, right? We go back to the last cut was in the depths of the pandemic, and then over those last years of interest rate hikes and the pain that came with them and the pain that was associated with that, this is a fairly big move. In and of itself, it's going to have a pretty immediate impact on variable rate mortgage holders right across the country that are going to feel as much as like $150 a month benefit as a result of this change. We saw the banks this afternoon all announce they're moving their prime rate. But really, I think what's interesting here is the extent to which the Bank of Canada has burst the doors open to further rate cuts. Now, it's being very coy about saying it doesn't know when it expects to see those happen, or that it's going to go meeting by meeting to make sure that it doesn't go too quickly and move too fast. But, you talk to economists across the country, and they're expecting to price in a fair number of cuts. I think the markets are now assessing like a 60 or 65% chance that we'll see another cut when the bank meets in July, as many as 3 cuts by the end of this year. Frances Donald, the global chief economist at Manulife Asset Management, has said that she expects to see 8 rate cuts by the end of 2025. So a lot of movement, but still that's kind of the next big question for the Bank of Canada, or what are the conditions in which it will make the next cut?
Yeah, why is the governor so reluctant to give Canadians somewhat of a timeline on these cuts to ease some of their anxieties?
For sure. I mean, look, there's a bunch of reasons. And the one he will cite is that they don't want to get ahead of the data. They've got a bunch of data coming in. They're happy with what they've seen so far. But there have been wobbles, and they don't want to get ahead of that and move too quickly. But look, JP, it's clear. We've talked about this before. There have been messaging mistakes in the past. They said that interest rates were going to remain low for a very long time, and they didn't. They said inflation was a temporary thing that people shouldn't get too worried about, and it wasn't. And there has been some anger and some frustration from not just politicians, but Canadians across the country that are really frustrated with how the Bank of Canada has communicated a lot of these decisions. So I asked Tiff Macklem, the Bank of Canada governor, about that this afternoon, about whether he's worried about sort of the credibility of the institution as a result of these last couple of years. Take a listen. Do you worry about central bank sort of communications through this and the ability of that central bank credibility to emerge from this tough period intact?
I do. I think it has been a very difficult period for Canadians. And I think one thing that, we've had to relearn a bit from this period is that people hate inflation. It really cuts into their budget. They get a raise, but then they go shopping and they realize my money's not buying what it used to. It makes people angry. It does. It erodes confidence in our economy, in our system. And so that is a worry. And that's one of the reasons why it's so important to get inflation back down. Yeah, we have some, we've taken a bit of a hit, and we're going to have to rebuild that trust.
The question, I think, JP, is how do you rebuild that trust? And I think a big step of it is getting rates moving back down and communicating them, but convincing Canadians across the country that have been suffering that this institution is working to make their lives better. And that is certainly a job that is easier on the way down than it was on the way up.
All right. Thanks, Peter. The CBC's Peter Armstrong. Thanks for coming on, sir.
You bet.
And you can watch more of Peter's interview with the Bank of Canada Governor tonight on The National, 9 p.m. on CBC News Network and 10 p.m. on CBC TV. Now, to break down what this interest rate cut by the Bank of Canada will mean for Canadians, Jimmy Jean is the chief economist and strategist at Desjardins. Armine Yalnizyan is the Atkinson Foundation Fellow on the Future of Workers. Welcome back to the show, you two.
Thanks for having us.
Thanks for having me.
Armine, you've been critical of rate hikes in the past. Are you happy with Tiff Macklem today? Did the bank do the right thing here?
Let the easing cycle begin. It is so long overdue. And in fact, we're not the only ones. Just a few hours ago, the ECB, the European Central Bank, also cut rates. And we're expecting to see a rate cut from the US. It's very likely next week. So, everybody is pricing in more rate cuts, at least 2 more in the year. Everybody's moving in the same direction. But just to remind your viewers that by the time this year is over, we will not be that much eased at all. We are still in a very restrictive zone if we don't come down even to 4%. And even in Europe, where it's much lower than that right now, they just dropped to 3.75%. That's still super restrictive for an economy that's really struggling.
Jimmy, are you comfortable with a rate cut right now? I mean, the consumer price index in April, it still rose 2.7%. It's a bit elevated. Is there a chance that all this is happening a bit too soon?
No, not at all. I think the evolution of the consumer price index going forward is really how the Bank of Canada is calibrated on, and what they've been seeing is, and unlike what we've seen in the U.S. or even in Europe and in the U.K., is that in Canada, inflation so far this year has been well behaved, has been going in the right direction. And for the reasons that this monetary policy cycle has led consumers to tighten their belts, so it's reduced discretionary spending, and it's helped bring down inflation. So what they wanted to see was that they wanted to see an economy that was also under control. And in the first quarter, GDP came in 1.1 percentage points below what they were even expecting. So it shows an economy that's still struggling. You have more labor availability as well, so that's helping bringing down wage growth. So the whole inflationary spiral theme, I think they're reassured about that. Government spending was elevated, but not in a nature to really boost inflation the same way we saw during the pandemic. So all those things together means that 5% was way too high.
I mean, there's a risk, though, that this could juice the housing market, isn't there? I mean, it could push up already elevated prices further. A lot of money has been sitting on the sidelines waiting for something like this, waiting for a cut. Do you think that there's a risk this rate cut actually makes the housing affordability crisis worse?
Oh, look, I think the path ahead is deeply uncertain, notwithstanding all of the rate cuts that are baked into the system, and notwithstanding the fact that we are still in super restrictive territory. But I think the issue here is that the Bank of Canada might be getting more friends because they're starting to cut, but they're not friends of the next generation of Canadians who are struggling as renters and struggling as wannabe home buyers. This is not making life tons easier. Because I think the prices will start jacking up almost immediately when people start anticipating there's going to be a cycle of easing.
Yeah, Jimmy, I think even the governor himself conceded that point at the House of Commons committees a few weeks back. He said they're expecting prices to go up for homes this year because of rate cuts potentially, but other factors as well. First of all, when do you think we'll actually start to see some of those rates come down for variable rate mortgage holders? And do you worry about this actually juicing the price of homes, actually making it more difficult for first-time home buyers to get into the market?
Yeah, well, I mean, in the case of variable rate borrowers, you're seeing the impact being instant. Typically variable rate mortgages will move 1-for-1 with the overnight rate. So those are the ones that will see some relief. They're the big winners today. They've been the big losers in the last 2 years. So it's only a small consolation prize. I mean, but I think when you look at people that are going to be renewing, and to Armine's point, it's still going to be very painful. It's still going to be a major step up in mortgage payment going forward, just less so than it would have been if the Bank of Canada hadn't moved. Now, in terms of stoking housing market pressures, sure, you have a lot of pent up demand, but the first time home buyer is still struggling to qualify, and that's really important. So long as this is the case, and if we see in some markets some demand come back, then it's going to boost prices, and we're going to end up at the same point where a lot of people won't be able to qualify because of that. I'm not that concerned that we'll see a big wave of exuberance in the housing markets, given the current economics. Really, what you need to see is simply more supply for things to get more affordable. It's not the interest rates that will do the trick, and that supply will take a very long time, many years, not decade, before it comes online.
Armine, you mentioned the ECB, you mentioned the U.S., but Jerome Powell, the U.S. Fed chairman, he has been more hawkish, right, than other central bank leaders. He doesn't seem, at least last I heard, not too keen on cutting rates. You said you expect them to do it next week. What gives you that confidence that that is actually coming in the U.S.? And is there a risk, though, if they don't cut, that there is a divergence between Canada and the U.S.? Could that have implications for our country if we're cutting and the U.S. is staying where it's at?
Yeah, good question, JP. But, you know, the issue here in the United States is we rebounded in Canada faster than they did after the global pandemic. And so they had a great year last year, but they're starting to punk out now. And they are still at incredibly, like, we're seeing wage growth being suppressed. We're seeing all sorts of signs that things are cooling off. And don't forget, every central bank will tell you it takes 18 to 24 months for what they do to kick in. And just a reminder that the last time the Bank of Canada raised rates was last July, not even 12 months, right? June and July, we saw 2 rate hikes. So there is still the full brunt of those hikes, which I think were too much in my estimation. They were too much and too late in the cycle. They were waiting to cool down the economy, and they did. Today, the Bank of Canada governor was talking about excess supply, not excess demand, as he had been talking about for a while, which means, he said, the great news is that we can grow a little bit faster without triggering inflation. Well, that also means that people are just not hiring as much, and we can expect the same story to play out in the United States. And even though they're closer to historically low rates of unemployment, it's not great news when your wages don't keep up with inflation. I mean, to Jimmy's point, even if you're not buying a house, you're not going to be able to not only qualify for a mortgage, you can't qualify for most rents in the big cities because your wages just can't keep up. If you lose where you're living, it's going to be really difficult to find an affordable place. That is the big issue. And it's partly the Bank of Canada's fault, but it's also partly that we have been under protecting the affordable stock we do have and underbuilding literally affordable. I'm not talking about CMHC definition of affordable, which is 80% of market rate. That ain't affordable for many people, but truly affordable rents for people, which is 30% of their incomes. We haven't been building that for decades. So we're going to start doing that. But to Jimmy's point, that's going to take a while to come on stream. There's a world of pain to come yet, even when they start cutting rates.
Yeah, Jimmy, Macklem said today, don't expect rates to go back to where they were in the pre-COVID period. Like, forget about where they were during COVID. They were not even necessarily going to go back to 2019 levels anytime soon. They're not going to necessarily cut rates as quickly as they raise them. In fact, that's probably not going to happen. What do you expect? Do you expect more rate cuts this year? Give us a ballpark figure for where we could end the year.
Yes, so we think it continues. We expect another cut in July, and in fact, a total of 4 cuts for this year. So we should end the year at 4%. So from 5 to 4%, it's already a step. We think there's more cuts into 2025. We expect the end of 2025 where it will be at 2.5%. So we'll have cut rates in half, and that's when the relief effect will probably being felt more by that time. But in the meantime, yes, I agree. It's not going to change the circumstances for many people. I think the reason the Bank of Canada goes at it so gradually is that you still have some risks to be it, coming from the global situation. We have geopolitical risks and tensions that can cause flare-ups in globally exchanged prices. You also have the pressures you're seeing in rent. So today's announcement definitely doesn't change anything. It doesn't move any needle, at least for now, in the rentals market. You still have that demand-supply imbalance that is pushing rents higher. And, I talked about that disinflation story. It's been everywhere except in rent. So that's something that's going to stick. And for that reason, the Bank of Canada still has to be cautious because its mandate is 2%. And if you have one factor that is risking you're not attaining that, you still have to be attuned to that. And I think all central banks are going to use that same playbook as well. So the Bank of Canada is not different.
Right. Okay, let's leave it there. Smart thoughts, as always, from you guys. Thank you so much, Armine Yalnizyan and Jimmy Jean. Thanks for coming on, guys.
Pleasure. Thank you very much.